Welcome to the Deep Dive. Our mission here is simple. We take a stack of financial sources, articles, earning transcripts, and we give you the absolute shortest path to being well-informed.
And today we are tearing into the Q3 2025 results from uCloudlink Group, or UCL.
This is a fascinating one. It's really a story of a big corporate transition, massive statistical extremes, all kind of wrapped up in a really confusing earnings print.
It was definitely complex, and, the market reaction tells you everything you need to know about the quality of these results.
How so?
Well, you had this huge headline earnings beat, but the stock immediately closed down on the day, what was it, almost 4%?
And the volume is huge.
Oh, the conviction was intense. Trading volume surged something like 70 times the prior session. That tells you the big money was watching, and they decided very quickly to focus on the underlying operational health, not those top-line numbers.
Okay, so let's unpack this core conflict for you right away. The headlines, if you just glanced at them, they looked absolutely stunning.
Unbelievable, yeah.
UCL reported GAAP EPS of US $0.24 per ADS. Now, analysts were expecting US $0.02. So that's a staggering, 1,100% surprise beat. Usually that kind of number launches the stock into orbit.
And that is exactly why we have to immediately look past the GAAP figure. While that massive profit, US $9.3 million, grabbed all the headlines, the total revenue came in at only US $21.1 million.
And that was a miss.
That was a miss, yeah. A miss of about $1 million against consensus, and it was a steep 16.0% year-over-year decline.
So right there, that's the story. A revenue miss on one side, an 1,100% EPS beat on the other. That's the definition of a mixed print, but the market, like you said, sided with the negative view. Why? I mean, the street is usually thrilled by big surprises.
They were focused on the quality of the earnings, or maybe the lack thereof. When you strip out all the non-operational noise, the core business actually showed significant weakness.
Okay, so let's look at those operational metrics.
Right. Adjusted net income, which is the non-GAAP number, was only US $0.7 million. And that's a sharp decline from US $3.7 million just a year ago. And then adjusted EBITDA, which gets you closer to underlying cash profitability, came in at just US $1.4 million. That's down painfully from US $4.4 million UI. The market saw that instantly and realized that enormous GAAP profit number just wasn't sustainable.
And that is the crucial distinction you need to get your head around here.
Yeah.
So let's spend a minute on exactly where that US $9.3 million GAAP net income came from. It wasn't from selling more mobile connectivity.
No, not at all. Precisely. The CFO clarified that the GAAP net income was almost entirely driven by a huge one-time US $8.7 million fair value gain on other investments.
Okay, hold on. Break that down for us. What's a fair value gain?
So it's a mark-to-market accounting adjustment. Think of it like this. The company owned another asset, maybe a piece of another venture, and the accounting rules just require them to reassess its value on paper this quarter.
And that assessment just happened to show it was worth US $8.7 million more.
Exactly. So it's basically a paper profit. It's an investment that looks more valuable now, but it didn't generate a single dollar from their core activity of selling connectivity or hardware during the quarter.
So that's the key takeaway. It's non-operational.
Right. It has nothing to do with day-to-day business, and it is highly unlikely to happen again at that size. That single detail explains the whole discrepancy. Spectacular, but paper-thin, GAAP profit versus sharply declining adjusted earnings. The market looked at that, mentally subtracted the $8.7 million, and saw a company struggling with profitability during a big transition.
Which brings us directly to that strategic transition. The market punished them for the lack of core profit, but management is clearly trying to pull off a necessary, if painful, pivot. We see that story playing out in the revenue structure.
We do. Total revenue was down, yes, but the structural mix, improved the overall margins quite a bit.
So services revenue.
Services revenue, the recurring higher quality part of the business, it held up pretty well at US $17.0 million. That's only down 1.4% year over year. But what's really significant is the proportion. That services segment is now 80.6% of total revenue.
Wow, up from what?
Up sharply from just 68.6% a year ago.
So that shift proves the strategy is working, in a way. They're becoming less reliant on one-off device sales. But that came at a very sharp cost on the product side.
A very sharp cost, yeah. Product revenue was, it was decimated. It came in at only US $4.1 million. That's a brutal 48% year-over-year decline.
Ouch.
But the silver lining is that by leaning away from that low-margin hardware, the overall gross margin improved a lot. It hit 53.6% compared to 48.4% a year ago. They're selling fewer things, But the things they are selling are much more profitable.
And that's the strategic trade-off, right? Sacrifice top-line revenue for higher margin quality. But the immediate, painful consequence of all that seems to be cash flow. The market wasn't just worried about falling adjusted earnings. The cash flow picture flipped negative.
And this is where the market's caution is absolutely justified. The company reported a negative operating cash flow of minus US zero month never $1 million this quarter.
And just to compare, last year,
Same period, they had a positive US $2.0 million inflow.
so that's a nearly US $3 million swing in the wrong direction. They burned cash this quarter just to operate.
Exactly. And this operational burn is a major concern for investors, especially when you couple it with their rising expenses. Total operating expenses jumped to 52% of total revenue.
52%.
Management says they're investing heavily in R&D and marketing to build out this new ecosystem. And while that supports their, disciplined execution narrative for the long term, the short-term reality is a high burn rate and negative cash flow.
I have to push back a little on that disciplined execution idea then. If your expenses are eating over half your revenue and your cash generation just flipped negative, how sustainable is that? That US $28.5 million in cash on the balance sheet sounds good, but not if you're burning through it.
That is the tension investors are grappling with. You're exactly right. They're betting on the long-term payoff, but that cash runway makes the conversion of that growth pipeline absolutely critical.
Okay, let's pivot and figure out why the revenue missed by that $1 million. It sounds like this was less about a catastrophic failure and maybe more about a timing issue.
That's a crucial distinction. Management broke down that product sales decline into two parts. First, US $2.6 million was a deliberate cut in low-margin data products, the stuff they want to get away from.
Okay.
Second, and this is the important part for Q4, US $1.1 million was from two large delayed mobile broadband orders from a key customer in Japan.
Wait a second. So if the total revenue miss was $1 million and US $1.1 million that miss was just two specific orders that they expect to ship in Q4, that pretty much accounts for the entire shortfall.
It does. It immediately changes the conversation from weak demand to deferred demand. And now let's look at another area that signals strong dynamics, the geographic mix.
Right, that shift was dramatic. Japan, which is historically their biggest market, dropped from, 46.6% of revenue all the way down to 33.2%.
And at the same time, mainland China just soared. It went from about 28% a year ago to become the largest contributor at 35.1%.
And that's the travel recovery story.
Directly, management credits it to the ongoing recovery in outbound travel from China and strong adoption of their new 5G roaming and eSIM solutions. So they're capitalizing on recovery tailwinds in China.
Okay, this shows the core travel business still has pockets of growth. Now let's leave the dollar figures behind and focus on the health of the platform itself. This is where that transition narrative really shines.
This is absolutely the bullish thesis for UCL. Even though revenue missed, core user metrics are surging. Total data consumed increased 9.0% year over year to over 49,000 terabytes.
And the users.
Average monthly active users, or MAUs, grew 11.9% YoY to over 761,000. So the platform is getting bigger and people are using it more.
But the truly explosive growth is from what they're calling the GlocalMe ecosystem 2.0. This is their big multi-vertical strategy.
That's the engine room of the future. The growth rates here are spectacular. I mean, they're starting from a smaller base, but these are much stickier revenue streams. For instance, IoT MAUs grew 593.3% year over year.
593%.
The life segment, which includes that PetPhone thing, saw MAU growth of 382.3%, and the SIM segment grew MAUs by 188.2%.
Let's quickly define those. So IoT isn't just laptops, it's embedded systems.
It is. They secured orders for in-car infotainment systems, security cameras, targeting providers across North America, the Middle East, Europe. They're embedding their connectivity layer into next-gen devices.
And PetPhone, the life segment, what's the play there?
It's connecting personal devices that tap into an owner's emotional investment, like a pet tracker. And it seems to be working. They began the initial commercial rollout, secured initial orders for about 40,000 units, and set up a new North American online retail partnership.
And finally, the SIM strategy.
The eSIM Trio solution showed really strong product market fit in its pilot, high user registration, good active engagement. This segment is key because it requires less hardware and really leverages their 392 relationships with mobile operators around the world.
Okay, let's connect all this back to the broader investor story, especially with the recent stock performance. It's up a fantastic 91% over the last year, but it's suffered a really painful 41.5% drawdown in just the last 3 months.
And that drawdown, that recent intense selling shows investors are prioritizing the immediate revenue pressure and the negative cash flow despite all that strategic momentum we just talked about.
So what's the signal the market is waiting for to reverse that trend?
Conversion. The market needs to see conversion. They're waiting to see all this high user growth, these huge MAU percentages, turn into sustained cash-backed revenue growth. Growth that isn't reliant on one-time accounting gains to look profitable. They need to see that the high investment burn is finally turning into positive operating cash flow.
And management did provide guidance. They framed the full-year revenue range as revised to account for macro headwinds.
Right. They reaffirmed the full year range of US $81.3 million to US $85.8 million. For Q4 specifically, the guidance is US $22.0 million to US $26.5 million. And that's a huge range. It implies anything from a 15% YoY decline at the low end to almost a 2% increase at the high end.
So that brings us to our not financial advice segment. Here we pitch an aggressive, short-term trade idea that leverages the catalysts embedded in that guidance.
Absolutely. And of course, the necessary reminder, this is not a recommendation to buy, sell, or hold securities. Investing involves risk, and you should always consult your own registered financial advisor before making any decisions.
All right, disclaimer done. Based on this very mixed print, what is the most outrageous but plausible bet for UCL in Q4?
The pitch is a high-conviction, short-term, long position, but it's contingent, entirely contingent, on them executing on this Q4 catalyst we identified.
The delayed orders and the PetPhone shipments.
Exactly. The Q3 miss was narrow, just $1 million. The catalysts for next quarter are that US $1.1 million in delayed orders from Japan and the successful shipment and revenue recognition from those first 40,000 PetPhone units.
So the thesis is the market overreacted to the Q3 cash burn, and they overlooked the fact that the entire miss was basically deferred revenue that's going to hit in Q4.
That's the bet. You're betting that the negative sentiment reverses sharply once that deferred revenue hits the Q4 print. If they ship that Japan order, they stabilize the core business. If they also book revenue from the 40,000 PetPhones, they could easily hit the high end of their guidance. It's a bet that the 41% drawdown was an overreaction to a timing issue that resolves itself in the next 90 days.
A pure catalyst play. Very aggressive. It's a bet on management execution.
It's a bet on them hitting the high end of their own guidance range, driven by specific deferred revenue.
That wraps up our deep dive into UCL's Q3 2025. This was a quarter defined by an impressive but totally non-operational GAAP EPS beat. There was significant pressure on revenue and core EBITDA, and a really concerning flip to negative cash flow.
But on the other hand, you had undeniable operational momentum from that explosive user growth in IoT, SIM, and PetPhone. The story is transition volatility.
So here's the final thought for you to mull over.
Right. Given that management explicitly blamed long hardware decision cycles on macro headwinds, how much of this quarter's revenue shortfall is a transient timing issue that just resolves itself in Q4 versus a structural ongoing shift away from high-value hardware purchases in their legacy markets?
That structural question, is hardware dead or just late? That's what will determine if this drawdown is a fantastic entry point or just a warning signal. Thank you for joining us. We'll see you next time as we cut through the noise.